All right, let's talk RF Industries, ticker RFIL. They just dropped a quarterly report that absolutely lit a fire under the stock after hours. So we're going to dig in, break down exactly what happened, why it's such a big deal, and what we think is coming next.
And I'm not kidding about that fire. The stock immediately popped over 11% in after-hours trading the second those numbers came out. So what exactly did the market see that got it so excited? Let's get into it.
So the headline here is a big one. It was a clear, decisive earnings beat. RF Industries didn't just squeak by the estimates. Nope, they blew right past them on both the top and bottom lines.
Okay, let's look at the numbers. Revenue came in at a solid $19.8 million, which is a good $1 million more than the analysts were expecting. But you know the real story here? It's the profit. Their non-GAAP earnings per share, that's basically their core profit, hit 10 cents. Wall Street was only looking for 7 cents. That's almost 50% higher. That's not just a beat, folks. That is a blowout.
And when you dig a little deeper, the quality of these numbers is what really jumps out. I mean, yeah, revenue growth of over 17% year over year is great. But look at this gross margin, 34%. Their own target was 30%. So they're not just selling more stuff, they're selling it much more profitably. It really shows they're getting smarter and more efficient, and that's exactly why this is their fourth straight quarter of operating profit.
So you're probably wondering, how did they pull this off? Was it just a lucky quarter? Nope. This was no accident. These results are the payoff from a very deliberate strategy shift that management has been working on for a while.
And you can just hear the confidence in their voice. On the earnings call, the CEO, Rob Dawson, basically said their big goal, getting to at least a 10% adjusted EBITDA margin, is now within reach. When a CEO says something like that, it's a huge signal. It means they think these awesome results aren't a fluke. They're the new normal.
So what's the secret sauce? Well, it boils down to this three-part game plan that's really changing the company's DNA. They're moving from just being a simple component supplier to becoming a full-blown solutions provider. They're doing it by diversifying into new, higher-value markets, getting deeper with their current big customers, and creating brand new partnerships to get into totally new ecosystems.
All right, let's talk about what this strategic pivot actually looks like in the real world. We're talking about a major shift into some really high-value markets, and believe me, it is paying off big time for their bottom line. And the proof is everywhere. They are landing repeat orders in aerospace. We're talking mission-critical stuff. They're gaining real traction in the absolutely booming data center world with their cooling solutions. They are securing deals to wire up major airports. And get this, they're building a sales pipeline for over 100 sports venues, just in time for the Olympics and World Cup cycle. These are not small, one-time deals. This is high-value, sticky revenue that completely changes who this company is. And oh yeah, the market has definitely noticed. Over the past year, RFIL's stock is up a mind-boggling 135%. Just to put that in perspective for you, it's absolutely crushing the broader small-cap and industrial indexes, which are both struggling to even hit 20%. This right here is what you call dramatic outperformance.
Okay, so the story so far is fantastic, but where do we go from here? We've seen the great results, but now we need to look ahead. Let's talk about what could push the stock even higher, and also tackle the one big question mark that's on every investor's mind. So, looking forward, here's what you want to keep an eye on. Can they keep the momentum going with their big Tier 1 wireless customers? Can they show us even more proof of their wins in aerospace and data centers? And maybe most importantly, can they keep those amazing gross margins above 30%? Any of these would be a huge positive, especially if the broader economy helps out with some lower interest rates.
But, like I said, there was one thing in the report that wasn't quite perfect. There's this one number that definitely gave some investors a little bit of heartburn, and it all has to do with their order backlog.
See, at the end of July, their backlog looked great, sitting at $19.7 million. But then, on the call, management mentioned that as of mid-September, it had dropped down to $16.1 million. Now that decline, well, it naturally raises some questions about what revenue is going to look like in the fourth quarter. It just injects a bit of uncertainty into the picture.
Okay, so we have to weigh everything. On one hand, you've got this incredible performance and fantastic margins. On the other hand, you have this question about the near-term backlog. So after crunching all the numbers and listening to the call, we've come to our final verdict.
When we put it all on the scale, the positives just weigh so much more. The killer execution, the diversification strategy that's clearly working, and those expanding margins. For us, they easily outweigh the backlog risk. We see that as a short-term manageable issue, especially with the strong pipeline they're building in these new markets.
And that brings us to our official rating, what we here call the next call.
Our rating on RF Industries is a solid outperform. We are convinced that the fundamental momentum in this business is real and will keep driving the stock to beat the broader market.
So here's our thesis in a nutshell. First, the pivot is working. This shift to being a solutions provider, it's unlocking fatter margins and just a better overall business. Second, they have serious operating leverage now, which means as more sales come in, a lot more of that cash is going to fall straight to the profit line. And third, they are right in the sweet spot of some huge trends, like 5G and all the data centers being built. So our call is this. We think they'll handle the Q4 backlog just fine, keep those margins strong, and as they prove that out, the market is going to reward them with a higher valuation heading into next year.
This is not financial advice.